Both NASDAQ and S&P 500 hit an all-time high. High-yield bonds, or also known as junk debt, is catching up to the S&P 500. However, very interesting that utilities broke two new all-time highs as well, and I think that this means that we could see interest rates drop, and by extension bonds will continue to rally. And we'll look at gold, which could be about to pull back. All this and more in today's edition of MasterChartsTrading.com market recap for Friday, July 18, 2025. Please don't forget to hit the like button, share this video, make a comment. These actions are what keeps this channel going. Thank you for that. If you're a subscriber, stay tuned. We'll be covering various securities in the members only section, namely market breadths, Bitcoin, some of the Forex, crude oil, ETFs, some of the large cap stocks, and a whole bunch of various speculative securities. Digital Turbine, big congratulations on this stock. Pagaya Tech, big move on that. Unity Software as well, big move on that. So stay tuned if you're a subscriber. If you're not a subscriber, consider signing up by going to the website MasterChartsTrading.com and sign up there for two of my products, trading indicators and newsletters. Throughout the presentation, I'll be using my proprietary MasterChartsTrading.com price action indicators, which you can see on this chart, this green, blue, red, and yellow lines. These indicators are used for support resistance, as well as determining if the stock is in an uptrend or a downtrend and at what point to buy. So it's pretty much all inclusive in one on these four lines. We are currently looking at the S&P 500, which is at all-time highs. We've never been here before. These are all-time record highs again. Very big V-shaped reversal. Notice this drop into April and then just non-stop move higher with multiple gap ups. Multiple gap ups imply a strong buying pressure. So we have several gaps which I circled. They're still not filled, so eventually we don't know when these gaps will get filled, but we don't know at what point. They could be filled, in 5 to 10 years. For now, it does seem like the move is continuing, and we are continuing to play this on the upside. We're looking for opportunities to buy various stocks, as well as stay in the game on the open positions. Namely, NASDAQ, QQQ. I personally bought NASDAQ right there where I'm hovering on 8th of May, right there. So I bought QQQ, the ETF, and it's been pretty much doing nothing but going up. So since I bought it, it went up 15%. But from the beginning of this move, from the 7th of April, it is up actually over 39%. Wow, that's a dramatic move for sure. So a very big move, but you know what? It continues. Seems like technology stocks are definitely outperforming the rest of the market. For example, healthcare is down in the dumps, but various technology-related firms are actually in very strong uptrend and at record highs. Some of them are at record highs. So for now, again, I am staying in the game. I am telling my subscribers to continue stay in the game, keep the positions open, and not yet really any strong indications that we're about to roll over to the downside or even trade sideways. I mean, we traded sideways, here since maybe like 2nd of July, but now we have a new record, so we're technically speaking broke out of this tiny little consolidation. High yield bonds, junk debt. A few days ago, last week, I mentioned that what I thought was a potential minor bearish divergence. I mean, it's still there. In other words, the junk that hit records on the 3rd of July and haven't yet hit all-time highs, but whereas stocks on 3rd of July also hit records, but then continued to hit records until today. So there's a small divergence, but it's very small, and today's action might just negate the entire thing. And I think we might see new records for high-yield bonds as well. As always, I wanted to point out the reason why I care about high-yield bonds is because I look at the correlation between high-yield bonds and S&P 500. Correlations between the high-yield bonds and S&P 500 are very positive. You can see that this correlation coefficient where I'm hovering, this yellow graph, spends most of its time in the positive territory, with a very occasional foray into negative territory. And notice right now we have a very high degree of correlation again. 85% of the time high-yield bonds and stocks are doing the same thing. So when there is divergence between S&P and high-yield bonds, I start to worry. But I think at this point we can kind of relax, because I just don't know if, I mean, anything can happen, but Monday most likely next week most likely we'll make a new record for the high-yield bonds. So for now, again, I'm not terribly worried about the fate of the stock market. Here's another very good point. XLU utilities just hit a new record, and the fact that utilities are amongst the leaders to me is actually a good thing. Some people say that, oh well, this is a defensive sector, so you don't want to see utilities lead, but to me this actually could be the opposite. Maybe the reason for this is because utilities in general, the way they operate, they need to borrow a lot of money to keep their businesses operating. So new breakout to new all-time highs for utilities could imply that interest rates are actually going to be dropping, and this will further stimulate the economy. So I'm sure you have heard about the current row between the president and the Federal Chairman Jerome Powell, where Jerome Powell is kind of holding firm on interest rate increases, and Donald Trump, president, is doing his thing where he wants to have lower interest rates. So let's look at the interest rates. Here's the 10-year Treasury note yield, and really there was very little progress either way between last December really and now, more or less traded around the same area. Currently, the way this chart is looking, this is 10-year Treasury note yield, so the interest rates. Currently, it's technically speaking in an uptrend. In other words, according to this chart, I think we will be going up with interest rates. But it's not like very decisive. I kept saying, for example, a few weeks ago, we had a drop below this blue line, which is at 4.36%, and I thought, okay, that's probably it. We're going to continue lower towards the red line, and then finally, once we close below the red line, which is at 4.06%, about 4%, we will most likely continue even lower to like 3.8%. This didn't yet happen. In fact, we turned around and continued higher. So it's kind of very indecisive chart. So we will need to kind of just wait again and see what happens. We can also look at the opposite of the yields. We're currently looking at IEF, which is a 10-year Treasury bond fund, and we're also buying this fund. So we're buying the bonds, which would imply that the interest rates should be in a downtrend. And it does seem that way according to this chart. So I think if we are a little more patient, I think the interest rates will drop in the not so distant future. And perhaps Jerome Powell's job would be saved. Let's look finally at the US dollar. So I definitely saw that dollar was topping. I actually wrote it here when it was doing this. This was back in February of this year. It completely unraveled and continued to new lows. When I saw this pattern right here on the 1st of July, I thought that we're done, and I wrote here rebound very likely. We got our rebound. So currently dollar is at what's called first resistance. This first resistance, you can see it's literally this yellow line. See this yellow line on my indicators? It's acting as resistance. We have 1, 2, 3 times we tried to go above it. So far we have failed. Today's action is actually not bad for the dollar bulls. This does look like a hammer candlestick. So I think another attempt at a breakout above the yellow line would be made sometime next week. By extension, when we think dollar is going up, we think gold should be going down. Gold has been basically trading sideways again since about 20th of April or so, and basically we've been trading sideways. However, like I just showed, dollar has finally started to strengthen here on the 1st of July. So 1st of July is right there, and even though dollar has strengthened, gold really didn't take advantage of it. It just traded sideways. When dollar strengthens like this, gold should have, continued lower. It really didn't. It didn't go up or down. It just traded sideways. So I'm now wondering if we need to wait until dollar breaks above this yellow line and maybe continues towards this red line, which is another, about 3% higher or so. So it's definitely possible that this will continue, and I think gold could come under pressure as a result. There is obviously no way to tell, but there is a good chance that gold will come under pressure should dollar continue to strengthen. So we'll be watching that. We're also watching gold miners. This is gold miners ETF, GDX. Also new highs were not yet made, so kind of trading sideways. This pattern, sort of like an upside down W, I'm going to draw it out, also as not ideal right there. So if we get a breakdown, like a close below this 27th of June lows, I think we will break below significantly and maybe continue towards this blue line. So should that break occur, at the very least we might see a move of about 8% or so towards the blue line, and then we'll reassess. Currently gold and gold miners are still in an uptrend, but like I just said, should dollar continue to strengthen, this could weigh on gold and gold miners. That's it for this week's recap. Let me know if you have any questions, and then head over to masterchartstrading.com, click on sign up for one of the products. So again, I have 2 products in one bundle, trading indicators. These are these lines on the chart. They're available for tradingview.com, this green, blue, red, and yellow line. Again, you can trade pretty much anything under the sun. These lines are used for trend setting, as well as finding good entry points, as for example you can see on this chart. Whenever a security pulls back towards the blue line, we buy it there. So those are trading indicators. They're available for this interface, tradingview.com, and once you sign up on tradingview.com for a free TradingView account, come back to my site, Master Charts Trading, and sign up here, and I will open the door for you on tradingview.com. Sounds convoluted, but that's the only way to do it for now. Newsletters. So again, if you are just interested in trading on your own, I send out daily alerts about the various securities. For example, this week we looked at multiple securities here. You can see ETFs, Bitcoin, large cap stocks, and a whole bunch of speculative securities such as Unity Software, Roku, Rivian, Hormel, etc. And of course, the best deal is to get both trading indicators and newsletters. And if you sign up for the yearly subscription, it's a $49.95 equivalent per year relative to the monthly subscription. So you save 17% or 2 months free. As always, all of my plans come with free 7-day trial. So if you don't like it, you can cancel it, no charge. That's it for this week's recap. Let me know if you have any questions. Thank you for watching and have another great trading week. Bye-bye.